Inflation is finally falling. Yes, I know it's still a tad bit high, but at least now it's coming down a little bit. The most recent figures show that the consumer price index rose by only 0.1% in November. This figure falls short of the 0.3% estimate, bringing the annual rate down to 7.1%. Now the headline rate is at its lowest level since December of 21. It was a completely different world. Queen Elizabeth was still with us, FTX was still a blue chip company, Russia hadn't yet invaded Ukraine, and portfolios for investors were still looking very fresh and healthy. We were such a sweet summer kids at the time, especially those who were heavily invested in cryptocurrency too. However, the tables have recently turned and markets have plummeted and inflation has skyrocketed. But curiously, a recession has not yet materialized. Could this be a signal that things are beginning to change? Well, we all know that when the Feds increase interest rates, borrowing money becomes more expensive for both individuals and businesses. If you have a credit card, for instance, with a valuable interest rate, the interest rate you pay on your debt due will probably increase when the Fed increases interest rates. This will make it more challenging for us to take on more debt. Why? Because it can lessen the amount of spending and investment that we'll make. In addition, higher interest rates can also increase the allure of saving. Us people and corporations can profit more from our savings when interest rates are high, which will motivate us to save more and spend less. This also lowers the demand for products and services, which can further lower inflation. With this objective in mind, the Fed has increased rates by 0.75 percentage points over the last 4 meetings, and it's happening at the quickest rate since the early 1980s. Despite the fact that inflation appears to be easing, the Fed isn't going to slow down too rapidly. A 7.1% inflation is still at nearly 40-year high, so the job is not yet even near done for the Fed. As a matter of fact, the Fed raised the interest rate by 0.5 percentage point again just 2 days ago. Well, this was consistent with most analysts' projections based on recently released economic data and comments made by the Fed, Jerome Powell, in recent weeks. But will interest rates rise further? The Fed is likely to continue raising interest rates as long as the rate of inflation remains high. They made it absolutely clear that they intend to reduce the headline rate to the long-term target range of 2 to 3%, which means interest rates are expected to rise even further into the first half of 2023. From there, it will then be determined by how the inflation rate reacts. If it falls rapidly, as some predict, the Fed may even keep rates steady or even lower them in Q2, Q3. However, if inflation remains persistently high, rates will almost certainly continue to rise in the second half of 23. Actually, nothing about this is a surprise. The Fed's members expect that inflation will be brought under control in 2024. And it wouldn't surprise me if the real estate market followed the news once it began to change. Although nothing is definite, this may indicate to us that 2023 will be a better year than a disastrous 2022. I've been digging the last news, trends, working on videos for hours and hours, sleepless nights, all to give you guys the best and latest happenings going around. So if you want to keep updated, feel free to subscribe to my channel. It's on me, no worries, just kidding. And give me a like and a subscribe, and I'll talk to you later and see you in the next video.